Hi there and welcome to this special broadcast live here on Money Control. The show's called Earnings Express, and today we are here to be talking about the slew of FMCG earnings that we saw last evening. Now, to dissect those numbers, I have with me CNBC TV 18's Mangalam Malu. Thanks so much, Mangalam, for coming here and speaking with us. But let's break down each of these numbers. We had HUL, where we saw, we would say, a good set of numbers, holding steady for now.
Well, so the one trait that stands out in all the consumer companies that have reported numbers so far is that revenues across the board have been slightly below what the street was anticipating,
right,
whereas the operational performance has been a lot better. So while at the bottom line you see steady performance, as you say, the top line has been muted. The middle line, which is the operating profit,
right,
has seen a little more expansion, and that's what the case has been for Nestle, for HUL, and for ITC's FMCG business as well. The reason why Nestle moved higher and HUL and ITC are lower is because Nestle is growing at least 2 times the pace of the industry, and the street likes that.
But there was also a one-time profit that Nestle saw this time around. So give us some details on that, and also the fact that there was a stock split announced, which for Nestle works very well. If you see that it's trading above 20,000 levels, so a stock split as 1:10 would really work well. So give us some details on Nestle.
Yeah, a stock split in Nestle really works well because of the reason that you mentioned. It's a 24,000 rupees stock. It becomes 2,400 rupees, so it becomes a lot more accessible for daily liquidity, etc. But fundamentally it changes nothing. It's just liquidity that increases. It's like taking one bowl of Maggi and then distributing into 5 different cups. Having said all of that, yes, there was a one-off as well, but don't look at the one-off. If you just look at the gross margins, the company's gross margins expanded about 370 basis points. The street was anticipating that this would be around 80 to 100 basis points itself. So there's been a big jump in gross margins, which is basically telling you that the commodity cycle is now turning into these companies' favor. Secondly, the management commentary as well. They did speak about a couple of products seeing some gross margin issues, but then largely Nestle's commodity basket comprises of dairy and coffee. Both those prices are seeing some moderation.
Right.
The next quarter we will see better margins coming in these verticals as well.
So now if you have to compare these margins, especially of HUL and this, where HUL saw that one really slightly missing, we would say a minor miss, at just coming at about 2%. So if you have to compare these two and also the overall margin picture for FMCG companies, how should we look at them?
So for HUL, the volume growth was a problem. The margins were above expectations. So the volumes grew by about 2%, like you pointed out.
Correct.
The revenues grew by about a little over 3%, but that was still below what the street was anticipating by and large. What was positive again for HUL was that their gross margins, again, gross margins are basically your revenue minus cost of goods sold. So that basically tells you about the commodity environment and not the other expenses that the company has to make. That expanded by 700 basis points. The company took some of those savings and invested into advertisements. So of those 700 basis points, they invested about 400 basis points into advertisements. So earlier they would spend, say, of the 100 rupees sales that they made, they would spend 7 rupees on advertisements, but now that has increased to 11 rupees odd. Despite that, the margins actually beat expectations. The EBITDA came in at closer to 3,700 crores as against street anticipation of 3,600 crores. The margins were above street expectations by almost 100 basis points. And the management said that going forward, commodities does not prove to be a bit of a challenge. The challenge is that of growth. And to that extent, the third quarter will be extremely important because we have the festive season, we have post-monsoons, and this time around the festive season in the second quarter was also moved into the third quarter because of the Adhik Maas factor.
Correct.
So that delay will also come into the third quarter. With all of these things, is the street looking beyond just operating margin expansion and perhaps some top line growth in the third quarter or as well? Most definitely. Will these companies report that? Well, we'll have to wait and watch.
We'll have to wait and watch. But let's talk about inflation, because that is something that, these companies also look at quite specifically, and we're seeing that ease quite a bit, at least if you have to go by September numbers. So how much of that is going to translate? You already pointed out where we have that festive season that we are anticipating, but how much of that is really going to show on ground in terms of sales for these, in terms of volumes, all of that for these companies?
Well, everyone's anticipating that, there could be at least high single to low double digit sort of volume growth in the third quarter, but that's about the third quarter. And what happens then is something that we'll have to watch out for. We'll have to see a few more, commentary points coming in from the management. Speaking about ITC, their FMCG revenue grew by about 8%, but remember the previous year, it had 10% plus growth. So on a 2-year basis, the revenue has grown by about 9%, which is not very small on the ITC base. You know, they've crossed 5,000 crores per quarter in terms of food revenue, and that margins have also expanded year on year. The EBITDA margins, the EBIT margins have increased by almost 170-200 basis points. We've seen an improvement in their operational performance out there, 37-38%. The hotels business, which has been demerged, is doing extremely well too.
Right.
Most on the street were anticipating 10 to 15% sort of growth. The company has gone ahead and reported 21% growth. Now, the call that the street needs to make in these companies, because HUL and ITC as well have fallen about 10% from their highs.
Yeah.
They're not particularly cheap still at these valuations, but when have FMCG stocks been cheap, right?
Right.
So the call that the companies need, the investors or traders need to make is that should they look at the positives of the operating margin expansion and focus that onto the next few quarters, believing that revenue will come back, or should they look at the negatives from slow revenue and say that maybe the next few quarters these companies will have to spend a little more on advertisement to generate top line growth, so as a result of which the margin expansion that we've got is currently compressed as well. So that is a tug of war that maybe the bulls and the bears are having right now.
Right. One more point that I would want to focus on is the fact of, like you mentioned, commentary, where they've said rural demand, and that's what they were really anticipating for this quarter to, you know, have some bit of respite there, but doesn't seem like it has come. So is that wait going to be longer, or, you know, we can expect that also to turn around by the next quarter?
I don't think it'll turn around in the next quarter. HUL management has said that, and you and I can see that as well. You know, all of August there wasn't much rain. September, okay, ho hum sort of thing. June was good rains. June, July. The important part is what happens to the rural economy, and will it grow? Yes, it will grow. Monsoons in some parts have also been normal. A lot of people are looking to also increase their spends as well. So there will be recovery, but it will be very gradual. And with the August month having not a lot of rains, we've seen that, you know, maybe there could be some bit of an impact in terms of delayed recovery. Recovery is happening, but gradual and perhaps very spread out going forward. The question is, despite that, will we continue to see urban discretionary income and urban discretionary investments and urban discretionary sales increase, and that will take care of the weakness that we are seeing in the rural business? That's something we'll have to watch out for.
Right, but I think that dichotomy is quite stretched if you have to see from what we are getting, and FMCG players are the ones that really show us that picture if we have to go by that, right? Well, you did mention the bears and the bulls will have to really figure it out, but an overall picture for FMCG, would now be a good time to be looking at them with all of this, or we should be playing that wait and watch game in terms of the stocks?
I would suggest that you know, FMCG stocks, usually the best returns you get in them when you do a consistent, disciplined, systematic investment plan. So at any given point in time, if you bought HUL over the last 5 or 6 or 7 years, you would be making money. At any given point in time, you bought any of these FMCG companies, you would be making money. But if you bought it at one particular point and held for it, waited for it to be a point-to-point return, chances are you might underperform. So in that case, it is best to make a basket of some of these high pedigreed names, the likes of HUL, Britannia, there's Nestle, there's Tata Consumer, there's Titan. There are 6 to 7 FMCG stocks in the Nifty itself, right? Just pick and choose all of them, and then pick a date of the month and pick an amount that you have to be investing, and keep doing that over a period of time. Over 5, 6, 7, 8, 10 years, you will be very happy, and you will thank your stars for actually having made that portfolio for yourself.
Right. So SIP is the way to go, at least in terms of FMCG companies. I'm going to ask you one final word on breaking down these companies as the good, bad and ugly in terms of their earnings. What would you say would fit in each of these categories when it comes to their revenues, margins, all of that?
Well, I wouldn't call anyone ugly right now, to be very honest. I would say that Nestle was better than HUL and ITC. ITC was good in parts, some parts not so much. HUL margin expansion was something which was very good. Question is, when do volumes recover?
Right. So I think we are going to have to leave it at that, on saying that we are waiting and watching FMCG companies at this point. Q2 quite steady for most of them. Operational beat is what we could give them as a verdict of what we're coming out of this second quarter for FMCG companies. Let me thank Mangalam once again for giving us his time and giving us his perspective on how one should be viewing FMCG stocks, and to all our viewers who've tuned in, thanks so much.